Welcome to Stocks in Translation, our essential conversation for cutting through the market mayhem, the noisy numbers, and hyperbole to give you the information you need for your portfolio. I'm Jared Blikre, and today I am joined, as always, by Sydney Freed. And today we welcome back Jay Woods. He is the Freedom Capital Markets Chief Global Strategist. And on the docket today, we're talking about the Fed. Big surprise, but we're all Fed watchers. We got the Fed's fearless leader marching up to Capitol Hill to tell Congress what's what about the monetary trajectory of the United States. And our phrase of the day is disinflation. Not quite deflation, not quite dis. We figure it out. And this episode brought to you by the number 80. That's a percent of the NASDAQ 100 gains this year that are attributable to the Mag 7. So concentration, guess what? It might be a problem after all. We will discuss. All right, Jay, first the story of the week. After last Friday's unemployment number surprised just slightly to the upside. We got CPI to get a read on inflation this Thursday, but Powell going in front of Congress too.
Yep.
Put it all together for us.
Yeah, it's his semi-annual meeting in front of Congress, and I'm sure he dreads this more than anything in the world. This is for show, but he has a stage, and he has a stage where he can actually deliver a new message. Because of that unemployment data, the roadmap is really there for a cut, and a cut a little sooner than people think. So I'll go out and say he could set the roadmap for a July cut. Will he? No, probably not. I think September looks more likely. But this is his time to get in front of Congress, and they get their sound bites. They get to yell at them, get their sound bites back to the constituents. Like, we're worried about the economy, and we got the guy in charge, so we're worry about you. But he gets to, get up there, avoid questions, not give us anything really interesting to talk about, but maybe he can, because he always telegraphs what he does. If he's late, first of all. We remember inflationary inflation being transitory, and then of course the first time they hiked, it was 3/4 of a point. They had to telegraph that through a leak to the Journal. So he has an opportunity. If we're going to do something July 31st, that's a long time from now still. Set the table, and maybe the CPI data gives it to us.
Jay, something I'm writing about in the morning brief, it's actually published Tuesday morning, so that will be the same morning as this coming out. All right, let me set the stage here. A lot of talk about the SOM rule, which is a recession indicator, but we haven't really heard a lot of recession talk. That's because it didn't happen last year, which a lot of people were expecting. But the SOM rule is very, very close to being triggered. If unemployment, I did the calculations, goes up to 4.2% the next month or the month after, and we got 2 prints before September, then we have suddenly all the headlines can say recession indicator flashes, red. What do you think about this? Does this make the case?
Well, let's talk about the SOM rule, and I'll explain it to you very simply. But it's a recession indicator. What other recession indicators have we had over the last 2 years?
Yield curve.
The yield curve has been inverted for the record amount of time. No recession. All right, 2 negative quarters of GDP. No recession. Now the SOM rule. The SOM rule states simply, when you get unemployment at its lowest point, which was 3.4%, if it is above that by a 0.5 percentage point on a rolling average of 3 months, so rolling average 3.9% for 3 months since the low, which I believe has triggered. I haven't seen the headlines, but my calculation said, 394041.
It's the low of the average.
The low of the average.
So it's a little bit different there. But I calculated it, and you can get it on the Fred website. It's 0.433. And if it goes up to 4.2, then it actually magically hits 5.0 on the dot.
Okay.
It just hasn't happened just yet. But, we're kind of horse trading here with respect to, basis points, very small amounts with these indicators. But I think in the bigger picture, I'm just wondering what if the recession indicators, if the headlines come out, doesn't that just give Jay Powell carte blanche to cut in September, even though there's an election on the horizon?
No, without a doubt. That's the one thing for this soft landing, inflation coming down, labor market softening, which is the nice word for saying people are losing their jobs.
Yeah,
that is exactly what they want to see. So they're seeing it. So let's go. I thought that last rate hike was unnecessary. So let's get it back down to 5% and then see how the market digests it, see how the economy digests it. But I think he has that stage now to talk about just that. And then, yes, the SOM rule is another one of these great indicators. So far, since COVID, all these indicators have just, you can throw them out the window. So it's a new era, I think.
Yeah.
You know, why, Jay, is that? Whether it's the SOM rule or whether it's the inverted yield curve, everyone yelling at you, there's going to be a recession, and then there's no recession. How does an early investor or someone who doesn't really understand all these different ways we might measure a recession, how do they understand whether or not we're heading in that direction?
Well,
Or just avoid it altogether.
Exactly. Well, we can argue there was a recession in 2022. We had rolling pockets where there were recessionary characteristics.
That's right, 2/4 of GDP, which was negative. That did happen.
Yep. And then we had the inverted yield curve. So we've had these things, but to have an official recession, we have to wait for it to officially be announced, and we haven't gotten that. So by the time they do it, it's usually backdated, and we've been in a recession for 6 months. So by the time they announce recession, we're halfway out of it, and that's the time to buy on that dip. So I don't call recessions. I'm not that, I'd rather look at charts and focus on sectors and individual stocks. But for the economists, they all have their indicators. And what we're seeing now is, they're right most of the time, but not all of the time. There are always exceptions to the rules. And I think this post-COVID era is that exception to the rule. So when they write about how come we didn't have a recession or why didn't this recession indicator work? Well, it works 9 out of 10 times now. It works 8 out of 10 times now. This will be that one-off.
These lagging indicators are driving me nuts, though. The two of you.
You want a leading one.
I feel like I ask this all the time. It's just like if it takes 6 months for them to tell us we're in a recession, if it takes any sort of data point to discover now is the time we're going to cut interest rates. I just don't get how anyone is supposed to take any information they get and actually do something with their portfolio.
Well, it's statistical probability. So when you're studying the market in any realm, whether it's technicals, economic numbers, you're looking for things that signal a possible move. And this has signaled it quite consistently over time. So we'll see if the SOM rule is the one economic indicator that actually says, okay, we're hitting recession. And I have an indicator that's not lagging.
Ooh.
I go on vacation in August.
All right.
All right. And 1 out of every 3 August, I get called back to the New York Stock Exchange because something bad happens in August. So between August 10th and 17th, I expect a down week because one thing.
It's like the Jay Woods VIX wrapped up in a little package
Listen,
here.
I will put it out there to social media beforehand. I won't tell anyone where I'm going. I want to get away.
Copyright,
But
whatever this turns out to be.
I just don't need to be called back to work or
August
pick
is
up
when the
phone.
VIX perks up. I mean,
August is extremely volatile. August, September, 2 worst months.
but Sid, back to your main point,
Yeah.
I would recommend charts to anybody who wants a leading indicator who's going to tell nothing speaks to you like the hard right edge of a candlestick chart.
Stop. I
Please.
can't do all the charts here. I'll just ask you to do the charts for me.
Well, I'll show a couple, and you'll see what I mean. I think charts lead more than anything else, so that's kind of my preferred. All right, we got to talk our word of the day here, and we've been tracking inflation, disinflation, deflation. We're talking about disinflation today. And what does that actually mean? It refers to a slowdown in the rate of inflation, meaning prices continue to rise, but at a slower pace. Unlike deflation, where prices actually do drop, disinflation indicates a reduction in the rate of price increases. And that's kind of what we've been seeing now. We've seen CPI is still elevated. If it's positive, it is not deflation. But if it is shrinking in terms of how positive it is, then it's disinflation. Jay, your thoughts on inflation?
Well, first of all, well said. That was great. Yeah, we're letting the air out of the balloon ever so slightly.
There you go.
And it's not popping. And that's exactly what we want to see out of the economy. And it's all about trends. Go back to your candlesticks, go back to charting. When you look at the trend of all these economic data points, the CPI, the PPI, the PCE, they're all going in the direction that the Fed needs it to go in based on the fact that they raised rates. Now, the labor market unemployment going up slightly. So these slowing trends, you're not going to get to the 2% rate that you want immediately, but the direction is there. So as they start to trend, you want to see the Fed ease off a little bit and lower rates 1/4 point and try to balance it out. They're always late. We'll see if he acts this time. But the disinflationary trends are what I follow, and right now that is what we want to see. It's not deflationary. It's slow and steady, and that is a good thing.
So Jay and Jared, we have inflation, disinflation, deflation. What about hyperinflation?
Very misused term, I would say.
I'm not going for this
throw
one.
a definition
I'm going to go to
behind
Jared
me.
on this one. I mean, this is me not studying hyperinflation, but if it happens too rapidly like COVID, would that have been hyperinflation when we saw things go through the roof?
I don't think in the U.S. I think hyperinflation is really a loss of confidence in the currency itself. So it's a crisis of confidence in the currency. And a lot of times that can be preceded by any number of events. People ascribe it to money printing. But the funny thing about hyperinflation is it's marked by an increased demand for cash. So the amount of money that the Fed is printing or the central bank is printing is demanded by people, but that's only because they know tomorrow their currency unit, whatever that is going to be worth less than it is today. And so it's a vicious circle. You can look at the charts of the currency for Turkey, for Argentina. Those are countries that are pretty close to, if they're not in hyperinflation, there could be a crisis of confidence, you could say there. But historically, you talk about Zimbabwe, where you got to add a few zeros every month. That is definitely hyperinflation.
Who talks about Zimbabwe? I have never heard that
Right
talked
now,
about.
Jay,
Okay,
right now.
All right.
So we're dealing with inflation right now. We are seeing disinflation because we're seeing the rate of inflation slow, correct? For all the early investors out there.
Yeah, for most items, we are seeing the year-over-year numbers go lower. Although some of them have kind of stalled out. Not all the components are going down. Some are actually going up. The shelter components, those have been stubborn. Some months those go up. So it hasn't been disinflation all around.
Yeah, we're waiting for those shelter components, meaning the rent and the housing numbers to come in a little bit, and that could help with a rate cut because mortgage rates come in, but then prices go. It's a juggling act, and I don't envy the position they're in right now. But we are waiting for housing numbers, and I think rent is starting to soften. That's a lagging indicator as well.
All right, we need to take a short break here. Coming up, we're going to be talking about the S&P 10. Yes, you're hearing that right. And a Who Wore It Better. That's all about fresh record highs. All right, we are back, and this episode, by the way, brought to you by the number 80. That's how much of the NASDAQ 100's gains this year belongs to those 7 magical stocks. I remember when the name was coined just 2 years ago, the Magnificent Seven, and these gains are so lopsided that we've got one Wall Street veteran, Mike Kantrowitz at Piper Sandler. He's throwing in the towel when it comes to the S&P 500 end-of-year targets. So this is an analyst who's just dropping out of the game. He says the closing level on the last day of the year, whatever the S&P 500 is, that doesn't matter anymore. So why do you think this is?
Yeah, I actually had a candid conversation with somebody at that firm today because I just think it's ridiculous. Let's have some fun. Put out your projections.
Do you think
what? Go ahead, Jared.
Do you think it was ridiculous in the first place, though? Just kind of the exercise?
No. We want to, it gives you the direction where you think you're not going to be right, but, are you bullish or are you bearish? What is your target? You see a 10% upside. Okay, that's the average over the last 30 years. That's not that big of a call. But to throw in the towel like that, I didn't agree with it. And I'm not going to criticize any individual or any individual firm for the way they do things. If that's their prerogative, then fine. But I think it makes for great fodder on a podcast and on TV.
Here we go.
And it's something that, you think the market's going to go up? Okay, how much and why? Well, it's good to have targets, and it's good to reevaluate them quarterly. I think it's something everyone should do.
Just to give our gentleman here a fair shake, he did say, and this is the reason I couldn't find it 2 seconds ago, that given the U.S. stock market, so this is the reason that the U.S. stock market has become more idiosyncratic than ever. That is, the risks are just down to a small number of individual stocks. Passive investment out the window. You can't tell anybody where the S&P 500 is, and you're shaking your head.
My gosh. Yeah, I heard that argument, and I wanted to scream. So I can scream here. I'm allowed to do that. It's a handful of stocks. Yes. And I saw, he said in 2022 we were down because of a handful, and we made it back in 2023. This has happened over time. Remember, AT&T was a giant for years. ExxonMobil was a giant for years. IBM was a giant for years. You're going to have leadership that takes the majority of the gains with them. Jump on their back. Enjoy the ride. Don't complain. Yes, the disparity between the haves and have-not, those top 10 stocks, you throw in Eli Lilly, you throw in Berkshire right now, JP Morgan new highs on top of the Magnificent Seven. They're having a great run. What we want to see is more participation. What happened at the end of last year, we got it. The setup is the same this year from a statistical point of view.
But still a question mark. Do we get the follow-on participation?
That's the big question, and maybe Jay Powell will help us with the little rate cut. That the Russell is flat as we tape this right now. What 6 rate cuts they were expecting in the beginning? I don't know who they are. I mean, I don't think we ever discussed 6 rate cuts.
Bond market vigilant.
Exactly,
like
but the 10-year continues to tick down. Things are favorable for the small caps to play a little catch up. And guess what happened last year when we were anticipating 6 rate cuts? The end of the October 27th low to the end of the year, the Russell ran over 25%. I believe it was 27% from trough to peak. Now it's stabilized, and we see that in a lot of sectors. They've had great runs. They've paused. They're not in downtrends. There's no bear market there. They're pausing. Guess what? Financials report on Friday. Let's see how they kick it off. And let's see if they can lead. They're up 10% year to date. Here's a fun fact for you, Jared. The XLF. I may have used this the last time I was here. It's been out for 25 years. That's the ETF that follows the top financial companies.
Large caps.
I was going to say.
You were asking me that with your eyes. I saw you. And what has happened in the 25 years, it's been up 15 years, down 10. That's not the greatest track record, but when it's up an average of 21%. We're up 10. And from a technical pattern, we're making new highs in JP Morgan. Citigroup looks like it wants to go. Bank of America at new highs. Goldman Sachs at new highs. Morgan Stanley at new highs. Guess what? If they have good earnings growth and a good quarter, don't expect Jamie Dimon to be rosy, but they've gone down 6 times in a row after they've reported, because Jamie Dimon, a little conservative, and I respect that.
And whatnot.
But then the results are just astronomical, and then people are like, oh, I don't care what Jamie says. You keep crushing it on earnings. But the financials can lead. Other sectors, healthcare can lead. Utilities flagged. They're not going to lead. Let's hope not. But they can join the party, and I think we'll see that broadening. In fact, the rotation just happened in the Magnificent Seven. Five stocks.
Yeah, within the 7, we're seeing quite a bit of rotation. And you were just going to say 5 stocks.
5 stocks made all-time new highs last week.
Yeah.
One of them is not NVIDIA, and Tesla.
NVIDIA was down, I think.
It was up like 1% last year. It can never go down. No, it can go down. But it didn't lead. It fell back. Apple coming back, monster comeback with their Apple Intelligence AI, very clever. And then you have Tesla. It's up 80% from its April low. We're talking April, May, June, 3-4 months. That's astronomical. At a major inflection point, technically, if you want to put up a chart of that, Jared, look at that on a 4-year daily basis.
It's right here.
Yeah, I mean, you connect that top high from 2021 down to the high now.
That's breaking out.
And put an RSI in there, and you're going to see above 85. It's retraced, and that's fine. This is healthy. They got 2 big events coming up. The 23rd earnings, and then August 8th, his automation robotaxi announcement. That's what's going to lift it above this downtrend. But right now, people rotated back into Tesla, and those Mag 7 stocks continue to do well. But when 5 of them are making new highs, I don't care there's a disparity. Yes, 10 stocks lifting the market, fine. Focus on them, because that's what you want to focus on. The leadership. When I looked at sectors, I look at the leaders, and then I see if everything else is coming for the ride. Procter & Gamble's leading the staples. That's good. Not everyone's going for the ride. We'll see if Pepsi can join it this week.
So Jay, distill this down for us.
Yeah.
Some people see a problem that we're not. They don't see this broadening out. You're saying there's not really an issue with tech leading. There are other sectors that might not lead, but they're there. There's a chance. Is that what you're kind of saying to people?
I mean, it is a red flag. Let's not ignore what is the elephant in the room. It's a horrible.
Put an elephant up here.
Yeah, it's a horrible
the
expression.
elephant in the room is NVIDIA. It's perfect.
Well, no, it's the fact that the breadth has been so divergent. I saw a statistic on Twitter today, and I can't attribute to who it was, and I've seen it many times. I did the research myself as well. We are at an inflection point since 2001 where the breadth between those leading and those down, it's like .com-ish.
Yes.
But it was also 2001 is when we saw this much of a divergence with fewer stocks joining the rally, and that was the beginning of the downtrend, not during a continued uptrend. So I think this time is a little different. And based on what we saw just at the end of last year, I think the Russell, everyone's making new highs. Russell's got 17% to go.
We want to keep talking about new highs here, and we're actually going to compare apples to oranges on the latest edition of Who Wore It Better. So how about comparing a stock to a sector that is unrelated to the stock? That would be Amazon and the communication services. If you look at the ticker XLC, so you take AMZN, you take XLC, and they have very similar charts. They both topped out in about 2021, suffered about 50% drawdowns, came all the way back up, and have only recently emerged. And I'm just asking you, who is wearing the recovery better? Is it Amazon or is it the entire communication services XLC?
Well, what's funny is Amazon's in the XLY, the discretionary. It's Meta and Google leading that, but you can argue it could be in either of the two. Listen, this is about those big stocks leading the charge, and they will make up the bulk of it. When Amazon is down, it's going to affect the sector more than any other stock within the sector. Same thing with now NVIDIA, which is 22% of the technology sector, up from 4.5%. That was a whole joke too, by the way. Apple now goes from 21% to 6%. I don't know who creates these algorithms, but if they're all three market caps within 100 million of each other, why don't you equally weight them? Because they're your top three in technology. But anyway, I digress. Getting back to your point, I think
Amazon XLC.
Yeah, I think the individual large cap stocks are the ones that are wagging the dog. Is that another expression?
Wagging the dog. So Amazon.
Yeah. So
and
you got to look at now. Technically, my God. Look at the chart on Amazon. This thing on a multi-year basis just broke out.
Yes.
It's got a 250 target on it. I think we're over 200 as we're taping this. The stock looks great. Their growth is tremendous. And this is a stock that everyone knows and uses. So it checks every box, and it's got an AI story too. So
you have to have an AI.
If you don't have an AI story, you're in trouble. There's no doubt about it.
My question, I don't know if it's for Jay or for Jared. How are sectors even? How do the stocks even go into sectors? Who decides this? And stocks can be in more than one sector.
Yeah, well, they actually can't be in more than one sector classification. So the standard is GICS. I think it's global something standard.
There are a couple different standards, but the S&P Select Spider Index is figured out by the S&P, and there are 11 different sectors. XLI is industrials, XLU utilities, so on and so forth. And then what they do, and this is how I study the market, I go top-down approach. You want to see where the leadership is. What sectors are leading? Well, technology's been leading, communications and discretionary. Discretionary, Amazon and Tesla. Utilities, they're not leading, and it's more diverse. But those biggest three sectors that lead the makeup is the biggest stocks in the market. So you can look for a basket of stocks by that index maker, or you can look for equally weighted stocks. And iShares has their own groups. There are different groups. I don't want to, pick favorites, but the standard that I look at are those XLIs, XLUs, XLKs, and that's the Spider Select ETFs.
All right, we want to get to some stories. We want to tell some more stories. We don't have any, but I bet you do here. You spent decades down at the New York Stock Exchange as a floor governor.
I'm so old.
King of the nicey.
28
but
years.
You're here now.
I'm still there, but not trading like I used to be.
I know you had some celebrity sightings.
Well, that's one of the great things about being at the New York Stock Exchange. You never know who's going to come the next day. Like not too long ago, The Rock came with WrestleMania when he was put on their board of directors, and there's The Rock walking right by you and taking pictures with everybody. You get the Masters champion, unless your name is Tiger Woods, to come down to ring that bell. It happened very frequently. And then the Olympics are coming. Oh, we get Olympians. It's like a rite of passage. At the Super Bowl you win, you go to Disney World. Yeah, Olympians win gold medals. You're coming to the New York Stock Exchange. So I've got, my old Instagram. I haven't gotten too obnoxious lately with the celebrity photos, but you get to meet a lot of people, and I was blessed to be in a position where I got to greet them and show them around a little bit, and it was always fun.
Well, we got to leave it there. Always appreciate you stopping by, Jay. Lovely to have you, and keep your dial tuned to Yahoo Finance.